This is the beginner's guide to investing in real estate in 2025, and in this video, I'm gonna break down everything you need to know to invest in real estate from someone who's flipped over 650 properties in the last decade. Whether you've invested in real estate before, you have a 9-to-5 job, and you've never done deals, this video is for you. I'm gonna break down everything from start to finish to get into your first deal or how to scale your real estate business. And I'm gonna show you exactly how I did it without ever visiting a property and without ever using my own money. Everyone in the real estate space talks about the same exact thing over and over again. But with this video, I'm hoping to break the internet and give everything that I know away for free. The next hour and a half is broken into 4 different sections. Section 1 is why should you invest in real estate? Section 2, where should you be investing? Section 3 is how to find the best real estate deals. And Section 4 is how to scale your real estate business. So with that being said, let's get into it. So first and foremost, I want to talk about what is investing. Investing essentially is when you take your money, invest it into something, and hope that that investment grows over time and makes you money and makes you return over time. And the goal with investing, the goal with real estate investing or stock market or putting into a 401k is that your money can grow without your time, right? Most of us work 9-to-5 jobs where we trade our time for money. The goal with investing is to put our money into something and watch it grow without my time and without my involvement. Now, what they call financial freedom is that when you're making enough money from your investments without spending any of your time, that's when you become financially free to a lot of people. Now, obviously with investing, profits are not guaranteed, right? You're investing, you're taking some sort of risk. It could be a low risk, but profits are not guaranteed, and the timeline of those investments also is not guaranteed, which is why it becomes a gamble to invest your money into anything. Now, the one way that you can really reduce your risk is by education and first investing in yourself, which we're gonna talk about later, but taking your money that you have and really investing it in yourself, into your education, so that you can be in control of your investments, more in control of your investments, and have a clear, lower risk profile with a higher profit margin, which we'll get into when we talk about real estate strategies. All right, now I wanna talk about why investing is important. And there's one major reason why I think investing is important and investing your money is important is because you can make money while you sleep. Again, all of us go to work, all of us trade our time for hours. Even if we make a salary, we still work 40 hours per week, right? So we still have a time per hour that we're exchanging with the company we work for, or the boss we work for, all that kind of stuff. The one way you can break out of that is by investing your money, taking your money, putting it into something, and making a certain amount of money every single day, every single month. That gets you out of the mindset of trading your time for money, which I think is a huge breakthrough for a lot of people. The other great thing about investing is that it builds wealth over time, right? It has compounding interest. You know, you invest 10,000 bucks, you make $1,000 a month, cool. Then the next month you're investing 11,000 bucks. Then the next month, 13,000 bucks, 16,000, slowly your investments can compound and grow over time if you let them sit there and you invest in the right thing with the right education. The other reason I love investing is it protects you from inflation. Now that we know why investing is important, I'm gonna go over the different types of investments. So you obviously have real estate, which we're gonna talk about in this 4-part video series. Then you have stocks and bonds and 401ks and gold and precious metals and starting your own business, and crypto and art and foreign exchange. There's so many things with us on social media that we get hit with on a daily basis of invest in this, invest here, invest in this Airbnb, invest in this farm in Brazil, right? There's so many different types of investment. Which is the right investment for you? The last one I have on my list here is investing in yourself and investing in you, and I think that's a great place to start. If you don't have very much money, a great place to invest is in yourself, in your education, so you can learn something, you can learn a skill that either you can go and charge a company more money for that skill that you have, right? For example, if you make 10 bucks an hour working at a job and you can go and invest in a course or an education and make 30 bucks an hour, that's a pretty damn good investment, right? It doesn't get you into investing your money for cash flow or growing your cash, but it is a great way to make $30 per month, which is a huge increase from the $10 a month you were making previously. Now, why should you choose real estate out of all those different investments? So my story started, I was around 8 years old and I started my first lemonade stand. That was my first business that I ever launched, was a lemonade stand. Shortly after that, my parents had a low carb grocery store, which I worked in from 8 to 10 years old. It only lasted a couple years. Then my parents started a sauce business. And they started a sauce business. It was sold around the country. I would go to Whole Foods and give out samples to people on the weekends and after school during the weekdays. Then Alibaba came around, Amazon FBA came around, and I started importing stuff from China and selling it on Amazon FBA. And I started my first real business. That was around 14 years old. And throughout all this time, I was selling stuff to kids at school. I would sell them candy and soda. I would sell them hats. I would import stuff from China, bring it in my backpack to school and sell it to everybody at school. So I've been a very, very entrepreneurial person, entrepreneurial kid my entire life, starting from 7 years old to where I am today at 28 years old. So a very long time, and there's a lot of different things that I have tried to invest my money and invest my time. But a big turning point for me was in 2015, 2014, when I went to a real estate conference and learned about real estate investing. I learned about wholesaling and fixing and flipping and apartment buildings. I learned about so many different ways to invest in real estate. And for the first 2 years, it took me 2 years to get into my first deal. The first deal I ever did was Memphis, Tennessee. I bought a house for $40,000. I eventually refinanced that house and kept it in my long-term portfolio. And then we started doing a turnkey fix and flip business where me and my dad would buy houses, renovate them, rent them out, and then sell them to other investors, which was the start of Martel Turnkey, and that business is still around today. After doing around 650 of those projects, I started a company called FlipSystem to help other people invest in real estate along the way, using the software and teams and knowledge that we have learned over the last decade. So with all that being said, all the different businesses that me and my dad and my family have tried, real estate investing is where we've built most of our wealth. And now I want to go over why I chose real estate. Out of all the different types of investments and things that I've tried, why did I choose real estate? So first and foremost, real estate gives you cash flow and passive income. It's one of the few investment strategies out there that you can buy something for $100,000, you can get financial leverage on it, you can get a loan on it, put down $20,000 and make a couple $100 every single month. There's hardly any investment strategies out there that you get cash flow and you can use some sort of financial leverage. Another great benefit to investing in real estate is appreciation. So that $100,000 asset that we buy slowly will appreciate over time, and it's a hedge against inflation as well. Because when inflation goes up, so does your property value. So you're hedging against inflation, plus you also get appreciation when you buy these kinds of real estate investments. Another great thing about real estate is the tax benefits that come along with real estate. So there's tons of different tax strategies when it comes to real estate. There's 1031 exchanges, which means when you buy a property, you can sell that asset, take those gains, the net profit that you had made, and roll that into another investment and not pay any tax. So that's a huge benefit. The other thing is you get a ton of write-offs with real estate. There's tons of strategies. You can take the asset, strip it down to its parts, and take that on your income statement and actually write off a ton of stuff with real estate. The other great thing is that unlike a personal residence or primary residence, when you get a loan on an investment property, all the maintenance and depreciation of that asset is a write-off as well. So for example, if you go and buy a turnkey rental property and you're making $200 to $300 per month, you'll probably end up paying very little taxes, probably close to zero, because of the depreciation and interest payments and mortgage and maintenance requests and all that kind of stuff that comes along with real estate. Control is also something that I love about real estate in compared to the stock market. For example, I can take $20,000 and buy a turnkey rental property where I own it 100%. I can do whatever I want with it. I can burn the house down. I can increase the rent. I can reduce the rent. I can leave it vacant. I can do whatever the hell I want to, right? If I go buy $20,000 worth of Starbucks stock or Amazon stock or a Google stock, I have no control. I just have to make sure that I think that business is going to be around in the long run, that those executives know what the hell they're doing. But again, I have very little control. If I want to increase the return on my investment on a Starbucks stock, not much I can do unless I go and buy, billions of dollars of Starbucks coffee in the next month, but I don't think I'm gonna go do that. Real estate is also great because there's value add opportunities, right? So I can, again, with the Starbucks stock example, I buy $20,000 worth of Starbucks stock. All right, cool. Now I'm gonna spend all my nights and weekends to increase my stock value. Not much you can do, but I can take that $20,000, go buy a single family house in Memphis, Tennessee. I can fly there. I wouldn't recommend doing this, but I can go fly there. I can repair the house. I can repair the roof. I can spend $5K on a roof. I can put in a new toilet, and slowly my property value, that $20,000 investment, is now worth $30,000, $40,000, $50,000 because I am increasing the property value and the value of that property. That's another great thing with real estate, is that you can get your hands dirty because you have that control to increase that property's value and increase your investment just with some manual labor. Real estate is also way less volatile. Again, due to a lot of these different components that I've talked about, with the control, with you being able to go and increase the value of it, you have way more control and it's way more stable than other things. For example, like the stock market, it's way less volatile. So for example, if there's another 2008 market correction and Starbucks stock goes from $100 per share down to $30 per share, not much I can do, extremely volatile. Or Bitcoin, for example, which is another great thing that's super volatile. It goes up and comes right down. It goes up, comes right down. It's almost like a vicious cycle every couple of years. Real estate is not like that. Real estate does not go up and down, up and down, up and down. Real estate is very, very stable, and it slowly goes up and to the right, which is great, and that's the way we want it to go. Also, if you look at rents, I think for the last like 300 or 400 years, rents have only gone up ever. They've never gone down in the history. So it's pretty crazy to buy investment properties and watch the rents climb up every single year, no matter what happens. So even in 2008, contrary to public belief, many people thought that rents went down in 2008. More people lost their homes and became renters in 2008, which caused the rents to stabilize and even go up a little bit. Obviously, it depends on the different cities and states that you invest in, but actually in 2008, and during times of recession, more people move and become renters than homeowners. So what does that do? The home values will come down, rents will stay the same. What does that mean? It's a great time to buy a rental property. So even during times of recession where the stock markets will crash, if you buy investment properties, you're very, very stable. Another great thing about real estate investing is if you're thinking about the long term and building a legacy for your family and your kids and your wife, or your husband, real estate has a lot of legal and financial functions in order to pass down the real estate investment without having your descendants or your wife or your kids, whoever they may be, pay a lot of taxes or pay for getting a lot of that real estate. So there's tons of different structures and trusts and LLCs and funds that you can set up for your descendants so that you can pass off that real estate without them having to pay any kind of taxes or pay any kind of fees for getting that. There's a lot of other investments out there where you don't have that kind of financial and legal instrument to pass down that real estate or that asset down to your descendants. All right, now that I've given you a ton of pros to investing in real estate versus other investment, I want to talk about the cons to real estate investing. Now, there's a few cons to investing in real estate. Number one, it's not liquid, right? Like I can again go buy 20,000 bucks of Starbucks stock. I can be like, I don't like Starbucks anymore and sell it the next day. Very liquid, the cash hits my bank in 3 business days, boom, very liquid. Real estate is a lot less liquid, especially if you start doing larger deals, multifamily, ground up construction. Your money could be locked in there for 5 or 10 years. If you buy single family houses like what I'm gonna talk about and what I recommend, your money is probably liquid in 30 to 45 days. So you can always sell a single family home. There's multiple different ways you could sell that asset to a family, to an investor, blah, blah, blah. And it probably is gonna take you 30 to 45 days to get that money out. So we buy a single family house in Memphis, we invest 20,000 bucks, it's worth 100K, we want that money out, cool, we can list that property for sale, hopefully get a buyer in a week or two, and they close 30 days later. So it's pretty liquid, but not as liquid as a stock market or as Bitcoin or something where you can it's on an exchange essentially, and you can just sell that and get the money in a couple of days. Another con to real estate investing is that it's not cheap. Real estate is not cheap across the country. You can find some cities and neighborhoods around the country where you can buy a house for 50 grand, but you probably have to get a loan on that. You probably have to put in $10,000 to $15,000 still for the cheapest piece of property or cheapest piece of real estate in America today. Stock market, I can go buy Starbucks stock for $100. $100 investment, $10,000 investment. $100 is way less than a $10,000 investment. So there is a little bit higher barrier to entry to invest in real estate. And there's a reason why that's a good thing, but it also could be a negative. For example, if you only have $5,000, it's gonna be hard for you to invest in real estate. I would recommend maybe investing in yourself and your education, doing something else. But if you don't have enough money to invest in real estate, it's gonna be really difficult to do that unless you get creative, unless you really go and raise private money or raise money from other people to get into real estate, but it's a little bit higher barrier to entry. So it's a con, it's also a good thing because it's less competition. Most of America, I think 95% of America has less than 14,000 bucks in their savings account. It was either that or $7,000 in their savings account. So there's a lot less competition, a lot less people can actually afford to invest and get into real estate, which is great for you because it means more deals. All right, now I want to talk about the actual physical real estate asset. Right? It's a risk to have a physical asset. Why is it a risk? Because there could be natural disasters. You have tenants living in the property. You could have maintenance on that property, and you could have nobody living in the property where you have a vacancy, right? Unlike the stock market or other different types of investments where you don't have these kind of issues because it's not a physical, tangible asset. Being a physical, tangible asset is great because it always is going to have some sort of value. I can always sell the shingles off the roof one by one for $1. I can always sell the wood. I can always sell the toilet. I can always sell the fridge, right? There's always some sort of intrinsic value with a physical asset, but that also comes with cons, right? So maintenance, the tenant could go and break something, or the roof on the house could cave in, right? So there's different things that come along with owning a physical asset, and one of those is maintenance. Second thing is vacancy. So vacancies are a big risk when it comes to real estate, because if your mortgage payment is $500 a month, your rent is $1,000, the tenant leaves, you're stuck paying the mortgage payment every single month, and vacancies are not good. We want to fill those vacancies as soon as we can. Another thing with real estate is you have to pay taxes. You have to pay property taxes, not income taxes. This is a different kind of tax. This is taxes to own the piece of real estate. You pay this to the city or county where that property is located. So for example, if you have a house in Memphis for $100K, you have to pay Memphis city taxes and Shelby County taxes. Two different kinds of taxes. That's going to sum up to a couple $1,000 per year. Typically, if you get a loan though, the mortgage lender is going to take care of those expenses and just bill you for it. But it is another con to investing in real estate, that there is this other marginal cost and tax just for owning a piece of real estate in that city or county. Now, natural disasters are also another con to investing in real estate. Again, you have a physical asset, there could be a tornado, a hurricane, a flood. There's tons of different natural disasters that could affect that piece of real estate. So that is one of the cons. There's obviously ways to mitigate that with different insurance policies and stuff like that, but it is one of the cons to investing in real estate is natural disasters. Last but not least on my cons to real estate investing is that it requires management. It requires somebody every single month to be managing that property, collecting rent, keeping up with a maintenance request, making sure the property is in good, working, livable condition. So it requires management, and typically you hire a property management company to actually manage that. The con to that is that they take around 10% of the rent as a fee every single month. So it is going to be another expense, and a con to investing in real estate is that it does require ongoing maintenance and management. All right, so now that I've laid out the pros and cons, I want to go over the different types of real estate investing methods. Right? We have different types of buildings, and then we have different types of investing methods. So first, the different types of buildings. We have commercial. Commercial building will be like a big warehouse, right? A big warehouse, and we're gonna have like an auto body shop in that warehouse would be like a commercial building. A mixed use building will be an auto body shop with apartments above it. That's mixed use because there's two different types of uses. Then we have multifamily, which is top to bottom, purely multifamily. I live in an apartment building right now. It's a 40-story building. It's completely actually it would be called mixed use because there's actually some retailers at the bottom, and then it's purely apartments on top. But if I lived in a 2-story apartment building, where it's apartments top and down, that would be considered a small multifamily. Then we have single family, detached or attached single family. A single family house, pretty obvious what it is. A detached single family houses is when you have two single family homes that have some space in between. If you go to Philadelphia, they love putting everything together, and those are called attached single family houses. And the single family home detached is actually my preferred method to investing in real estate. And last but not least, you have land. So this is buying actual raw land, and you can do developments. There's tons of different ways you can invest in land. Again, I'm not the biggest fan of land. Why? Because it doesn't produce any kind of cash flow, and it's hard to get financial leverage on it. Now, the investing methods. How can you take all these different types of real estate assets and actually invest in them? First method, the BRRRR method, is when you buy something, rehab it, rent it out, and refinance it. The great thing, it allows you to build a portfolio over time with very little capital. Second is flipping houses. Pretty self-explanatory, HGTV. You buy a detached single-family house, you renovate it, you put it back on the market, and you make a profit. Pretty simple strategy. Next one, developing. You buy a piece of land and you develop a mixed use building. You developed a commercial building, a multifamily building, a single family house. Different types of development, which again, in a high interest rate environment, again, not a recommended approach or strategy at this time in 2024. Last but not least is holding. So doing a buy and hold. So buying a multifamily and holding it, buying a commercial building, renting it out to an automobile manufacturer and holding that property, right? There's also holding and doing a little bit of value add. So buying an apartment building, increasing the rent, renovating the units, and slowly increasing the value of that land and that asset over time. Out of all these different asset types and all these investment strategies, what is my preferred method? It's a method that I made up on my own, and it's called the FlipSystem method. And you may be asking, what is the FlipSystem method? FlipSystem method is a combination between the BRRRR strategy and a flipping strategy. It's essentially where you buy the asset, you renovate it, you rent it out, and then we have multiple different exit strategies. We can either refinance out the property and keep the tenant. We can not refinance the property and hold it and keep the current loan that we have. We can sell the property as a turnkey investment, meaning we go sell this asset to somebody else who's an investor who wants to buy that asset and hold it for the long run. That's essentially the strategy that I did with Martel Turnkey, right? Buy the house, renovate it, rent it out, sell it on my website, martelturnkey.com, to an investor who wants to buy a cash flowing asset, and I make a short-term profit and they keep the long-term cash flow every single month. Now, the great thing about this strategy is that it's safer than almost all the other strategies combined. The reason why is because you have so many different exit strategies. You can refinance the house, you can sell it, you can list it as a retail fix and flip, you can hold it, you can keep the current loan. There's so many different ways that you can do these deals. And the reason why is because it is a single family house. I couldn't do the same thing with apartment buildings or multifamily or commercial. The reason why is because there's not that many exit strategies with those kinds of investments, and you're looking for big buyers that want to buy multifamily. For example, if I buy a $2 million apartment building, how many people on planet Earth can afford to buy a $2 or $3 million apartment building? Not that many. How many people can afford to buy an $80,000 house in Detroit? Lots of people, right? Investors, tenants can buy it. I can do a lease back to the tenant where the tenant can actually own the property in a couple of years. So doing this strategy with detached single family houses gives me tons of exit strategies and different ways to make money on the deal, which means that the risk is severely reduced because I have so many different ways to make money. Another great benefit to the strategy is that it allows you to grow your cash and your portfolio at the same time. Why? Because you are able to buy the property with the same exact house. At the end of the deal, you can either choose to refinance it or sell it for a profit. Cool, so I buy 4 houses this month, right? All those projects are gonna be done in the next 3, 4, 5, 6 months. I sell one, refinance one, sell one, refinance one. Cool, now I have more money in my bank and I have a larger portfolio at the same exact time, right? That's why the strategy is so great, because it allows you to grow your portfolio and also grow your capital at the same time. So you can start this entire FlipSystem method with $20,000. You can go buy a house, rehab it, rent it out, refinance it, or buy a house, rehab it, rent it out, and sell it. You can get 40,000 bucks in your bank now. Now we can do 2 deals. One we're gonna refi, one we're gonna sell. I'm gonna give you all the steps that it takes to implement the FlipSystem method. First and foremost, it always starts with finding a distressed asset in a good neighborhood. So we wanna go and find a single family house that needs renovation, where we can buy it, renovate it, rent it out, and then have one of the exit strategies, right? So we wanna go find this asset. We're gonna look on Zillow and Redfin and Trulia. We wanna find something below $100,000, typically in a city in the Midwest, that we can buy and rehab and rent, and then sell it or refinance it. Once we've found that asset, we wanna make an offer on that property. We're gonna make an offer with our real estate agent, get that house under contract, send out an inspector and lender and contractor. We're gonna get all that information back. Once we've collected all that information, we're gonna move forward with the property or back out of that deal. If we decide to move forward with that property, we start construction right away. Typically on construction costs, you wanna spend anything from 20,000 bucks to $40,000. You don't wanna spend too little because you're not gonna be able to get up to the appraised value. And you don't wanna spend too much because that's gonna have a lot of complications for your first deal. So to keep your first deal squeaky clean, I want you to spend $20,000 to $40,000 in renovation on that first deal. Once we are done with the renovations, it's time to list the property for rent and to get a tenant to move into that property. We wanna do this as soon as possible. We don't wanna get greedy at this point. We don't wanna list it as a retail fix and flip. We want to buy the house, renovate it, rent it out as soon as we possibly can. This is gonna reduce the risk to property break-ins and also increase our return on investment. Now, once the tenant has moved in, we're gonna have a property management in place. So even before all of this, which we're gonna talk about in a future video, we want to build a team on the ground, right? The property manager, realtor, contractor. So we already have a property management company in place. They're going to take photos, find the tenant, place the tenant, and then they're going to manage that property thereafter, right? So now we've bought the house, renovated it, rented it out, property manager's in place. Now it's time to explore all the different exit strategies. And we do this by looking at the numbers and looking at the numbers very detailed. Option 1 is to sell this house ready to go as a rental property, as a turnkey rental property, right? So we can go and list it on martelturnkey.com. We can list it on many other websites. And we just say, This is a turnkey rental for sale. There's a tenant in place, property management in place, the house is cash flowing. Do you want to buy it? I'll even give you a lender to help you finance this investment. So that's option number one, which I always look to sell the property and make a quick return on capital. The great thing about the strategy is that you make money on the sale and the investor makes the long-term cash flow. If after listing the house for 30 to 45 days, you can't sell the property, it's time to start the refinance process as soon as possible. Typically, to get into these kinds of deals, you probably used a hard money loan. So that's going to be a lender that funds your rehab costs plus also the purchase price, but they're typically really expensive. So if we can't sell the property, we've done a ton of marketing trying to sell the property and we can't sell it, it's time to refinance that asset. So we're going to go and get a long-term loan, go to like a Bank of America, Chase, Wells Fargo, you can start there. You go and get a refinance on that property. You refinance out the old loan, you get a new loan, you hopefully get some money back in the bank, and now you own a property and that property is part of your portfolio. Now, once you've completed this, if you go with a refinance process or the sale process, you're hopefully gonna have some of that cash back in your bank, and now it's just time to start the snowball and do it again and again and again, and slowly picking up speed. All right, so a little quick tip here. I've helped over 500 people get into their first deal using the FlipSystem method, and one of the main pain points that people have, and one of the things that people don't follow my direction on, is they buy the house, they renovate it, and they get greedy and they go try to list the property as a retail fix and flip. The problem is most of them get broken into at that point. Why? Because now they're listing this completely vacant house that they bought for $100K for $150, $160, $170. The criminals know that nobody's living in it. They can take a brand new photo of an HVAC, hot water tank, brand new kitchen, flooring, bathtub, right? The criminals now go break into that property and steal everything, and it slows them down a ton. They have to spend $5,000 trying to repair, not following the FlipSystem method. The biggest way to prevent a break-in is by having somebody live in the bloody property. So if you buy the house, renovate it, and rent it out immediately, you're really gonna reduce the amount of break-ins that you're gonna have, which is gonna increase your profit and also increase your happiness overall with real estate investing. Now that I shared with you a little bit about the FlipSystem method, I wanna talk about what you need in order to invest. What do you actually need in order to go out there and implement the FlipSystem method? First and foremost, you're gonna need to know the difference between good debt and bad debt, right? Bad debt is when you go and buy a primary residence and you pay a mortgage payment every single month. You go make money at your job and you pay this expense every single month. You have to pay for the mortgage payment every single month. On your investment property, however, your tenants are paying for the mortgage payment every single month, not you. So good debt is when other people pay off that debt for you. Bad debt is when you have to go spend your time for money to pay off your loan. That is a bad debt situation, and that is a liability versus an asset. You're also gonna have to have two important things to invest in the FlipSystem method. Number one is you're gonna have to have a good credit score. Good credit score is anything above 680. If you are 600 and above, that's okay, but you really should focus on getting your credit score above 680. We have a lot of people apply to FlipSystem every single day, and one of the biggest reasons why they can't invest in real estate is because they have poor credit scores. There's tons of softwares and companies out there that can help you increase your credit score by a couple hundred points in a couple months. Please go sign up for those companies and increase your credit score to above 680. Second thing you're gonna need is cash. Like I mentioned, one of the problems with real estate investing, one of the cons is that it takes cash to get started. It's not like the stock market where you can buy stock for $100. You're gonna need $10,000, $20,000, $30,000 to invest in real estate and implement the FlipSystem method correctly. I would recommend saving up at least $25,000 before implementing the FlipSystem method, even if we bought the cheapest house in America. The other benefit of increasing your credit score is that you're gonna get cheaper debt. The higher your credit score, if you have a 750 credit score, your interest rate could be 6%. If you have a 680 credit score, it's gonna cost you an 8% interest rate, right? So the more that money that we spend, the more time that we spend improving our credit score, and there's tons of different ways that we can do that, the lower that our cost of capital is gonna be, which means we're gonna get a higher return on our investment when we invest in real estate. A couple other ways to also improve your credit score is make payments on time, keep your balances low, pay down your debt, do whatever the hell you have to do, sell a limb to pay off your credit card debt. I would highly recommend doing it. I would avoid taking on any new debt. When you go and get a loan, the banks and lenders are gonna look at debt to income. So they're gonna look at how much money you make and how much debt you have, right? If your debt to income is 90%, they're like, how the hell can this person afford to even get a loan? So if you can increase your income, number one, or two, reduce your debt, or do both, it's gonna be a great way to increase your debt to income, or reduce your debt to income, which is gonna allow you to get better loans, larger loans, cheaper loans, from banks. So if you don't have $25,000 saved up, but you want to work towards saving up $25,000, I have a couple of tips and a couple of recommendations. You're going to need this $25,000 for the down payment on the house, for potential repairs, unexpected expenses that come along with it, closing costs, negotiating power, all these kinds of things. That's why you're going to need the $25,000. If you don't have the $25,000 right now, I would highly recommend cutting out as many expenses as you possibly can to save up to that $25,000 mark. That means canceling subscriptions, not eating out, reducing waste, negotiating bills with the credit card company, with the telephone bill, with the Wi-Fi. Reduce your living expenses, so live below your means. If you're making $10,000 a month and your total monthly expenses is $8,000, you're never gonna have enough money to invest in real estate, right? If you make $10K a month and your monthly expenses are $2,000, $1,000, a couple months, you're gonna be there. You're gonna be at $25,000 in the bank and have enough capital to go out there and invest in real estate. So you can, number one, try to make more money at your job. It's gonna be very challenging to do so. Another thing is you can control reducing your expenses, which is going to be way easier if you just live below your means. It doesn't have to be a forever thing, but it could be a temporary 3 or 6 or 9 month thing that you do to just put some money in your bank to be able to go and do that first investment. Now that you know why you should invest in real estate, we're going to talk about where you should invest. How to choose the right city, how to choose the right state, how to choose the right market to invest in. Then we're going to cover how to build a team within that market, how to find the property manager, realtor, and contractor in that local market to help you invest. There's really 2 ways to invest. You can either invest locally in your backyard or you can invest out of state. So when I first started investing in real estate, I was living in California. I could have invested locally, which I tried for 2 years. That's why it took me so long. Or I could have invested out of state, which now I am professional at investing out of state. It is my bread and butter to invest out of state versus investing in my local backyard. And most people choose to invest locally instead of investing out of state. Why do they do that? Because it's way less risky. It's way easier to go and see your properties. It's way easier to be involved in every single step of the process, which is all the wrong answers. I prefer to invest out of state because it forces me, it requires me to build a team on the ground that can function without me being there. I am now not a plumber or an HVAC or an electrician or a property manager, but if I manage the property next door, I probably would want to get my hands a little bit dirty, which is great. It makes the deal more profitable because I don't have all this overhead, but in the long run, it doesn't help me scale, which is great because it reduces my cost and increases my profit on that deal, but it's gonna make it really, really hard for me to scale up a real estate business if I'm ingrained and doing every single little job with that one property or second property. So in my opinion, actually investing out of state is better, safer, and more doable and more scalable than investing in your local backyard and buying the house next door. Number one is affordability. So for example, when I was in California, the minimum house was like $500,000. Then you would have to renovate it for $200,000 to sell it for $1 million to make $100,000 or $200,000 in profit. But then you had a hard money lender, then you had to raise gap funds, and you had to do all this kind of stuff to get one house. And I had to come out of pocket with 200 grand, which me or my dad and my family didn't have that kind of money. We had around $40,000 that we wanted to invest in. So that's what led us to investing out of state. Our first deal, we bought it for $35,000 and renovated it for $5,000. We did the deal completely cash for less than the down payment of doing a house in California. And for other people that want to invest in real estate, it's a way more affordable option. You can get into a deal today with 15 or 20,000 bucks instead of investing in your local backyard and spending $100,000, $200,000, $300,000 of your hard-earned money on just one deal. Now in that same example, let's say we did a house in California, we put $200,000 into that house and the deal goes south, right? We lose all our money on that house. The great thing about investing out of state, because the deals are so much smaller, I can take my $200,000 cash, let's say if I had that, and I can do 10 deals instead of just doing one deal. So it's actually a safer game plan because now I have 10 chips on the table instead of betting on just one house. Another great benefit of investing out of state, like I mentioned, is that you get to get out of the weeds, right? You're forced to use a team, to build the team on the ground, to do the things that if the house was next door, you probably would get your hands dirty with painting and flooring and carpeting and HVAC, and you'd turn into an electrician overnight. But if you invest out of state, you can't do that. You're not gonna take a plane after work every single day or every weekend to go clean up the house. No, you're gonna have to think about it and say, who can I hire? How can I reduce this cost? And then how can I increase the rent or make this business or this real estate asset profitable? Another reason I love investing out of state versus locally is that I can find deals on the MLS and there's a ton more inventory in markets in the Midwest, out of state, than there are in probably your own local market. So I've interviewed a ton of people that joined FlipSystem from New York, LA, San Francisco, Miami, that have invested in real estate locally and also with FlipSystem. And I think one of the biggest differences with investing out of state is that there is a lot more inventory. Detroit, right now, if you go to Detroit, Michigan, and you look on Zillow, there's 3,000 active listings below $100,000. Because there are so many more listings on the MLS and on the market with real estate agents, you as the investor don't have to go and get creative to find your first real estate deal. For example, if you were gonna flip houses in California, probably 80 to 90% of the deals you were gonna do are gonna come from off-market inventory, from wholesalers, from real estate pocket listings, from networking, from people you know. And that's a much harder route and a much harder path to get into your first deal. Versus investing out of state in a place like Detroit with 3,000 active listings, 80 to 90% of your deals now can come from the MLS. And when you first start, I recommend 100% of your deals coming right off the MLS, right off Zillow and Redfin and Trulia and Realtor.com. You can go to these websites, make offers on these websites, find deals that way. You don't have to get creative. You don't have to reach out to wholesalers. You don't have to do your own marketing. The inventory is there. And then when you buy one of these houses on the MLS, you have way more favorable laws. There's different kind of states. Some states are landlord friendly, some states are more tenant friendly, and some are right in the middle, right? Detroit, Michigan, for example, would be a state that's right in the middle. Ohio would be a place that's much more landlord friendly, which means it's better for business for you. For example, if you have a non-paying tenant or you want to get a tenant out of the property, it's going to take you 30 to 45 days. In a place like Detroit, Michigan, it may take you 90 days. In a place like California, it may take you 6 months or 12 months or maybe never. So that's why we like to invest in places that are much more landlord friendly. It's gonna be better for business. It's gonna allow us to scale our business and make our business profitable, which allows us to invest even more. Last but not least, one of the great things about investing out of state is that you get to open your mind up to emerging real estate markets. For example, I live here in Miami. There's certain neighborhoods in Miami that are coming up, that are sprouting up, where the houses are going from 500K to $1 million. But imagine if I opened up all of America to where I wanted to invest. How many cities do you know of right now that are coming up? Think about Nashville or Atlanta or Austin, Texas. Imagine if you can find the next Nashville, next Austin, right? And you can go buy those houses today for $100,000 or $200,000 and watch those houses skyrocket to $300,000, $400,000, $500,000 over the next 5 or 10 years. That's probably one of the most fun things about investing in the Midwest or investing out of state is that you get to go and taste and see all these different kinds of cities and see where you want to put your hard-earned money and what city you believe in the most to grow. All right, so let's say that you're sold on investing in real estate out of state, which I hope that you are. We now have to go and choose the right state. So what do I look for when investing in real estate out of state? How do I choose a state, and what are some things that I look out for? So one of the first things that I look for in a market and in a city is the 1% rule. So the 1% rule is gonna be a rent to value ratio. And I want this rent to value ratio to be as close as 1% as possible. So what do I mean? I want to find a house for $100,000 where the rent is $1,000 per month. So a 1.0 rent to value ratio. Rent to value, I want it to be 1.0. Now, in Miami, a $1 million house in Miami probably rents out for $5,000 per month. That is a 0.5 rent to value ratio. Do I want to invest in Miami? No. California, $2 million house rents for $10,000 a month. 0.5 rent to value rent ratio. Detroit, Michigan, I can buy a house for $70,000 that rents out for $1,200 per month. That's greater than a 1.0 rent to value ratio. This rule of thumb essentially means, is the property going to cash flow or not? So the closer that you get to that 1.0 rent to value ratio, the higher probability, higher likelihood that that property is actually going to cash flow. And that's one of the great benefits of investing in one of these places is that you can get the cash flow. You don't have to just buy an asset, lose money every month, and then hope it appreciates over time. So I want to find a place where I can get that appreciation of 3 to 8% every year, but I can also make cash flow every single month. So we want to find houses and find a place, a state or a city that has that 1.0 rent to value ratio. And real quick, the way that you can find this, you can essentially go to a bunch of different cities and you can find the median home price and median rent. Just use those two numbers and try to get them to 0.8 or 1.0 as close as you can. And then that's going to be a city that we want to dive deeper into. Now, talking about appreciation and talking about the growth of a city, I want to find a city that's not booming. I don't want to invest in Austin, Texas right now. It's too late. I don't want to invest in Nashville right now. It's too late. But maybe I want to invest in a place like Detroit, Michigan, which I think is really, really cheap right now and affordable, but I can see the potential. Maybe I want to invest in Cincinnati, which I went and visited. The home prices are really, really cheap and affordable, and I can see those home prices growing. So I essentially want to find houses and find cities that I see a long-term vision with that could be the next Austin, the next Nashville, that have a little bit of flavor, have some community that I can invest in and watch it grow over time. So I'm really not looking for the top 10 best cities to invest in. Most of those cities are going to be way too late. We want to find those cities before they hit that list. And that goes along with population growth as well. I don't want to invest in a city that's having some sort of hockey stick population growth. Tons of people are moving in, but the home prices haven't caught up yet. I prefer to invest in a place that's a little bit more flat, a little bit more stable, that I can see the vision of, I can see the potential of that place growing over time. And one of the reasons why I think a lot of these states and cities catapult like Nashville and Austin and all these different kinds of cities that we love, there's a couple of different reasons why. Number one is bodies of water. People love water. I think human beings love water, whether it be lakes or oceans. But people during the summer months across America love lakes. They love going into lakes, they love going into different bodies of water. So if you can invest and find a city that has some sort of body of water that is usable and people use it in the summer, that's gonna be a good sign. Another one is no natural disasters. This is gonna significantly lower your insurance cost on the properties. For example, investing in Florida, we have hurricanes here. Then you have to get super expensive insurance, which really eats into your cash flow and makes the properties way less profitable. Major sports teams is a big one. Cleveland, Ohio, this was a huge selling point and really builds a community within that city or town where you may be investing. So I look for a city that has sports teams, or maybe sports teams even coming. If you invest in a city that's super, super early, like Asheville, North Carolina is a city that's kind of been blowing up a little bit. They don't have any major sports teams, but maybe they are announcing one, or maybe they have a sports team coming into the future, right? Those sports teams, whether you like sports or not, really build a community within that city. And it's something that people are very prideful of, not only with their city, but then also with the real estate that they own, and they take care of it because of those sports teams in that community. Something else I look for is shopping and restaurants and live music, parks, mature trees, all the different things that human beings love to enjoy during the summer or the winter months, no matter when it is. Things that we can go to that are enjoyable, that you can see people using, or maybe they've built a new shopping mall or done this new thing, or there's new yoga studios popping up. All those kinds of things are leading me to believe that people are moving there and using these amenities throughout the year. Some other statistics that I look for with the city and with the state is also the unemployment rate and crime rate. So unemployment rate is how many people, or what percentage of the workforce is actually unemployed. You don't want to invest in a city that is run down or they don't have a lot of jobs. So you want to make sure that the employment rate of the city you're investing in is pretty close to the national average. Same thing with crime rate. I don't want to invest in a place that has super, super high crime. I want to invest in a state or city or county that probably is just national average in terms of crime. Diverse economy, I don't want to invest in a city or a state that has 100% of the jobs or 80% of the jobs in one industry. That's what happened with Detroit, Michigan. That's why Detroit, Michigan collapsed, is because 80% of the jobs were in automobile manufacturing. Then China was like, hey, we can do that for a tenth of the cost. All the companies started making cars in China. Bye-bye Detroit. So you want to invest in a place that has a diverse economy where no industry takes up more than 25% of the total jobs. That's gonna make sure that if one industry leaves, the city or state or county that you're investing in will be okay. Major employers. One of the reasons people move to different cities and different states is because of major employers that are there. If you have Amazon and Google and Facebook in the city that you're looking to invest in, that's amazing, because those people are gonna hire a ton of people, those people get paid well, those people pay rent on time, so those are gonna be great places to invest in. Also, you can look at who the current major employers are. For example, if the major employers are BlackBerry or companies that you see going out of business in the next 5 to 10 years, and they still have a ton of employees in that city or state or county that you're investing in, I probably would recommend not investing in a place that you don't believe in the companies that are actually hiring and have the most employees in that city or state or county. Another thing to look out for is colleges and universities. So St. Louis has amazing universities. Like, they have a top 10 university there in the healthcare and medical field. So if you can find a city that has some amazing universities, that's gonna bring in a ton of college kids. they go get their education. They have to have somewhere to live for that 3, 4, 5 years. And then when they leave, they're gonna go and get good paying jobs. Since they're already in St. Louis, they'll probably try to find a job there locally, which is great because you have a college educated person that is looking for a place to live, they're making good money, and that turns into great renters and great people to live in your properties. Something I look for more neighborhood based is owner occupancy rates. So when I go invest in a city or invest in a neighborhood within a city, I wanna look at owner occupancy rates. What that means is what percentage of the people in this neighborhood, in this zip code, in this city own their own home. I want that to be around 50-50 or 60-40, leaning more towards the owner occupied. Owner occupied means that somebody owns the house that they live in and they don't pay rent. They own their house and they pay a mortgage on that property. The people who own their own home take care of their home and take care of their neighborhood and community a lot more than a renter would. A renter is way more transient. They leave every couple of years. A homeowner could stay in that property for 10, 20, 30, 40, 100 years. So they're gonna take care of it, take care of the community. And if you have a high percentage of people of that community that own their own home, have been there for a really, really long time, that's gonna make for a great community and a great long-term investment. Now, last thing, I want you to go and follow some big whales. Go find some people on social media like myself that are investing out of state, see where they're investing. People that have done the research before, like I have. I've done all this research on all these cities across America. So you can either go do it again or you can follow some of the whales. Go look up some people that are investing out of state, some people that are doing turnkey fix and flips or flipping houses. Where are they flipping? Why are they flipping there? Why are they having so much success? And go follow some whales could be a really, really quick shortcut to finding some good markets out of state. All right, so now that I talked about the criteria that you should look for, I want to talk about how to do the research on these cities about those different things and different topics. So there's a couple ways that you can do it. Number one is tuning into the news. So tuning into the news about where people are investing, where they're having success, where are companies moving to, what companies are moving to what city in the Midwest. For example, like this new company is moving to St. Louis and they're hiring 50,000 people. Like that would be a great news article to find out where they're moving to, look at the house prices around there, see if you can buy some houses next to that new facility, which could be done in 3, 4, 5 years. That gives you time to go and buy houses in that neighborhood before that development is done. You can also join online communities and go in-person meetups. This is something that I did for the first 2 years of my investing career. I went to a ton of meetups in and around LA, pick people's brains around where they were investing, what they were looking for. If they weren't investing locally, which I hope they weren't, where were they investing out of state and why? And so going and picking other people's brains and seeing what other people are finding could be a good first step in choosing the right market. One thing my dad and I did a ton of in regards to all this research and data was we found a ton of statistics. So we went to the Bureau of Labor Statistics, BLS.gov. You can go there and find all of this data that I just talked about, completely online, completely free. Now, you obviously have to know how to use the data and leverage the data to figure out the answers to your questions. But if you can do that, I would go to the BLS.gov and check out all the stats that you can find there and figure out if you can find some stats that would answer the questions that we just went over. Last thing, ChatGPT is also a great tool that you can use. If you get the Pro, I believe that it can actually read the internet. So if you use that tool, you can ask it and prompt it different questions. Where should I be investing? Why should I invest there? Or this is what I'm looking for. Can you find some cities that could match all of these boxes? Now, since I've already done all of this, what states would I pick and what states and cities that I choose to invest in over the last decade? My dad and I ran a ton of numbers and a ton of stats on all these cities and many different cities and states across America. My dad was actually an actuary and ran dozens and dozens of these different stats reports. And we landed on the following states: Michigan, Ohio, Tennessee, Missouri, Alabama, New York, Indiana, and Kansas. So these are the states that we chose. And then within these states, we chose a ton of different cities: Detroit, Memphis, Cleveland, Akron, St. Louis, a ton of different cities within these states to invest in that match a lot of this criteria that we were looking for. So if you're looking to start and you want to invest, I would start with those states. Why? I've already done all the research. You can go and do it again as a great learning experience, but if you want to skip to it, you can just go and look up those cities and see if those cities would be places you would be interested in investing in. All right, so why did I pick those cities within those states? Now we're gonna go over the criteria that I look for in a city within the right state. Once we've chosen the right state, the criteria that I look for in that city to make sure that's gonna be a good investment for me and my portfolio. So first and foremost, I wanna find a city within a state that has a ton of inventory. So remember, like I mentioned, Detroit, Michigan has 3,000 active listings. I want to invest in a city like that. I don't want to invest in a city that may be in a great state that has great landlord-tenant laws, but it only has 4 active listings. It's going to be really hard for me to do anything. There's going to be so much competition on those 4 listings, I'm never going to get a deal done. So I want to have a city that I go on Zillow, I put in my criteria of below $100,000 and I find hundreds and hundreds and hundreds of available properties that I can buy below $100,000. So that's the first step, is lots of active inventory. The next thing I look for within the city is I want it to be safe, and I want to look for B and C class neighborhoods. So an A class neighborhood is going to be your prime downtown, A plus luxury, home that would rent out for the very, very top of the line people, the doctors and lawyers and that kind of thing. I don't want to buy that. The reason why is those properties are very expensive and they don't cash flow well. I want to find stuff that's B and C class. So it's a little bit of white and blue collar. There may be more crime than the A class downtown prime neighborhood, but it's going to be more workforce housing and working class housing. Those are the kind of properties that I look for. I'm okay with a little bit of crime. I'm okay with being 30 minutes outside of downtown where these people may work, but the rent to value ratios and the cash flow on these properties out in the suburbs are going to be way, way better. The other thing that I look for in a city before I start investing there is, can I find a good team on the ground in that city? There are so many cities in America that I've found that match my criteria, that look like great places to invest in. And then I call some property managers and I can't find one property manager that I would like to work with. I can't find one realtor that I would like to work with. Obviously, that's going to change with time because property managers are going in and out of business, realtors are coming in and out of business. So that's going to change with time, but that's one of the main deciding factors. If I can find a city that looks amazing, but if I can't find a team on the ground to do the work that I need done, it's not going to be a place that I want to invest. So again, like I mentioned, some of the cities that I invest in, Detroit, Cleveland, Akron, St. Louis, all these cities are great places to invest in. And this list, again, is always evolving. As companies and teams go in and out of business, the list is always ever changing and constantly changing as the environment changes. All right, so now that we've chosen the state, we chose a city, now within that city, we have to find the boots on the ground team, which again is one of the deciding factors if we should invest in that city or not. So who is on that team? That team is going to consist of a property manager, realtor, contractor, lender, title company, insurance company, accountants, lawyers, et cetera, et cetera, et cetera. So I want to find all of these people within that city to help me grow my real estate investing business. And the reason why they're so important is because the realtor is going to help me find the deals, the contractor is going to help me renovate the deals, the title company is going to allow me to buy those houses, as well as the lender is going to help me finance those houses. The property manager is going to find the tenant and manage the property, right? So all these different people have their key elements and a key process of the deal that they manage for me and for my business. And you'll be thinking, wow, that's a lot of people, Antoine. How am I ever going to make the deal make sense? Trust me, you can still make the deal make sense. A lot of these people get paid on a per deal basis, and they get a certain percentage of the deal as it goes through different stages, and they get paid on different things, right? Like a title company charges you a flat fee of $500 or $750. The property manager makes a certain percentage of the rental income. The realtor makes a certain percentage of buying and selling the houses, right? So these deals are still going to make sense financially, even though it sounds like a lot of people ingrained in the process. We want to give away parts of this deal. If the deals are successful, if they make money, they're going to bring us even more deals, which allows us to grow our business. All right, so how do you build this team? The first and most important person you're going to need is a real estate agent. You need the real estate agent to, once you find a house on the FlipSystem portal or on Zillow, Redfin, Trulia, you want a realtor to be your buyer's agent to submit a ton of offers. How do you find this realtor? Cold calling, looking on Zillow recommended agents, and just reaching out to a ton of them. I would call all of them. When I first started, I called 300 real estate agents, and I would call all of them. Hey, my name's Antoine. I live in California. I'm looking to invest in Memphis, Tennessee. Can you help me find houses, renovate them, rent them out, and then sell them or refinance them? Real estate investing sucks. All right, hang up and call the next person. 99% of the realtors you call are not going to be investor friendly, don't want to deal with houses below $100,000. So it's going to be really hitting the phones as much as you possibly can to find realtors on the ground that are going to be good to work with. At the end of the day, you want to find a realtor that's interested in making money with you and making money along the process, right? A lot of them don't want to do this kind of dirty work, deal with investors, do deals for 50 or 100,000 bucks. So you're just going to have to keep calling and keep hitting the phones until you find somebody that does and is interested in doing so. Next person you need on your team, which is very important, is the property management company. So the property management company, once you've bought that house, renovated it, you need a property manager to find the tenant and then manage that property over the long run. Best place to find these people is really on Google. is it's going to be way less phone calls than calling the realtors and the real estate agents. You're probably going to have to call 10 to 20 property management companies, keep following up with them. If you don't know what to ask them, that's okay. Just go on ChatGPT and say, I'm hiring a property manager out of state. What should I ask them? It's going to give you a list of questions. At the end of the day, the questions don't really matter all that much. Trust me, I've created an amazing script to cold call property managers for my team when we were growing Martel Turnkey into tons of different markets. It didn't really matter if we asked them certain questions or not. It really is trial and error. So just take it as that. It's trial and error. You're gonna have to try out these property management companies to see which one works for you. Next piece of the team is gonna be the contractors. Contractors is gonna be probably one of the most challenging things that you're gonna need to find investing out of state. My little hack for finding good contractors is to not find contractors at all. What do I mean by that? I mean that you wanna find a realtor or a property manager that already has access to contractors, and you can pay them a fee to be your project manager. So my little hack for managing contractors is to not manage them at all. Find a realtor, find a property manager, find somebody that already has a Rolodex of contractors on the ground that can do the renovations that you desire to renovate the property to be able to rent it out or to sell it. The next important one is lenders. Lenders like hard money lenders are gonna allow you to buy these houses with very little cash out of your pocket. So these lenders, which are called hard money lenders, are probably gonna fund 80 to 100% of your deal and fund 100% of the renovations. So you can go and find lenders online by typing St. Louis hard money lenders, Memphis hard money lenders. You can start there and call some of those companies. Some of the biggest ones in the industry are Lima One Capital and Kiavi. You can reach out to them. I think they lend in all 50 states. So if you want to start there, you totally can. But I would just type your city on Google and try reaching out to some of those lenders that could help you buy those houses, renovate them, and then refinance them later. Some of these hard money lenders also will do long-term financing. So not only do the fix and flip loan, but also do long-term financing, like 30-year financing, which you can leverage them for as well. Next thing is legal. So these hard money lenders, and when you're buying these houses with the hard money lenders, they're gonna require you to have an LLC created. So if you don't have an LLC created, don't worry about it. Don't make this, I feel like a lot of people get stuck here with a legal aspect, like I don't have an LLC, I can't invest in real estate. Okay. $300 and LegalZoom.com, you can make your LLC and be off to the races. So don't let an LLC stop you. It's super, super simple, super easy to make. A single member LLC, you just go to LegalZoom.com or make an LLC on Google, and you'll find a ton of companies that can help you make an LLC for $100. I would start there and make the LLC because the hard money lenders are gonna require you to have an LLC. They're not gonna lend you money to your personal name. So I would go make an LLC online. Again, you can do this as you're making offers too. Don't worry about having an LLC or not having an LLC. You can totally get started on everything else. The LLC you can get a couple of days before closing or a week or two before closing. It doesn't really matter. All right, last thing is taxes. A lot of people when they're investing in real estate are worried about taxes. Oh, I'm not gonna invest and make money because then I have to pay taxes. That's what happens when you make money. You have to pay taxes. Typically, your CPA, your regular CPA, should be able to handle you buying 1 or 2 or 3 rental properties per year without changing or finding a new CPA that is real estate related. If you feel like your CPA is not up to par and not up to where you want, you can always go and find a real estate CPA in your local market that can help you with the real estate savings and tax savings and all that kind of stuff. In terms of bookkeeping and keeping track of all the books and all that kind of stuff, when you're first starting, I would just use Google Sheets and just track income and expenses. And just at the end of the year, you can give that to your CPA and be like, hey, here's this house I bought it for this. Here's the closing statement, the HUD, here's all the income, and here's all the expenses. At the end of the year, your property manager is also gonna give you a piece of paper that you can just hand over everything to your CPA at the end of the year, like, here's what I bought, here's how much money I made, here's all the money I spent on it, all that stuff. So if this sounds like a lot of work, it is. Real estate investing is a lot of work, and I know that this video number 2, has been very, very beefy on choosing the market, building the team. This is where a lot of the work, and you really have to grind it out. It's not gonna be 3 phone calls here, 3 phone calls there, and boom, I chose my market and built my team. It's not that easy. It takes a lot of time. Again, it took me 2 years of doing this process in video 2, find my first deal out of state and actually buy that property. But it's totally possible and you can do it if you put in the work. Again, it took me thousands of cold calls, took me traveling to all these different markets, shaking a bunch of hands to find the right team and find the right city, find the right market to invest in. So you can totally do it. This video 2 is gonna take you a ton of time. So just take it step by step and take it very slowly because it is gonna take a lot of time and a lot of energy. If there's other things you can remove from your life, like for me, I was going to college at the time when I was doing this video 2 process. I moved all my classes from 5 to 10 p.m. so that from 8 a.m. to 5 p.m. I could focus on this video too, and it took me 2 years to crack this nut. So if you can beat me and do it in less than 2 years, props to you. And that's also because I did it alone, right? Like I didn't have anybody else that was helping me do all these kinds of things for that 2-year period. But that was the whole point of creating FlipSystem, was to help people save that 2 years of their life to do it way, way faster and way shorter. The reason why is because you don't have to do all these cold calls. You don't have to travel. You don't have to choose the right market. FlipSystem has already done that. That's the whole point of FlipSystem, is that we choose the market for you. We show you where to invest. We connect you with local teams on the ground, including the realtor and contractor and property manager that we've worked with to help you expedite that 2-year process and 2-year period of your life. And that's saving you a ton of money on the flights and the travels and the cold calls and moving around work and not traveling on the weekends, not hanging out with your family. It's saving you a ton of time and a ton of energy that you can focus elsewhere, and you can keep your day job and still invest in real estate as a side hustle. If that sounds interesting to you, head over to FlipSystem.com to book a call. We can chat and see if we can help you with this process, which is a big beefy part of the entire real estate investing process in video too. So if you want our help, head over to FlipSystem.com. We're gonna be going over what your first investment should look like, how to analyze deals and the different methods and different ways you can exit those deals. Then we're gonna go over different criteria that I like to hit and the criteria that I've hit for my last 650 houses, and then the tools you need. What tools do you need to actually go out there and find your first real estate deal? All right, so the first part of this is how to find your first investment, and it all comes down to the strategy, and we want to decide which strategy we want to implement for these deals. So which strategy is right for you? So remember in video 1, we talked about all the different ways to invest in real estate. We talked about retail flips and BRRRRs and the FlipSystem method, which is my recommendation. If you don't know what the hell I'm talking about, please go back to video 1 and recap yourself. But there's so many different strategies to invest in real estate, but what strategy is correct for you? In my personal opinion, if you have never invested in real estate before, I would follow the FlipSystem method. And just to recap, the FlipSystem method is where you buy distressed property, renovate it, place a tenant, and then you have multiple exit strategies. If you have never invested in real estate before, this is going to be the easiest and best way to invest because it's going to be the lowest amount of risk. You can BRRRR the house out. You can keep the loan and hold it. You can sell it as a turnkey rental. You can retail fix and flip it. You have so many different exit strategies with the FlipSystem method. The FlipSystem method, if you don't remember, is where you buy a distressed asset, you renovate it, you place a tenant, then you have 2 exit strategies. Number 1, you sell the property as a turnkey rental, and number 2, you can always BRRRR the property, which is where you buy, rehab, rent, refinance, and repeat, and the tenant stays in the property paying your mortgage payments for the long run. So if you haven't invested in real estate before, I would highly recommend the FlipSystem method. It's gonna be the easiest and safest way to invest with the most amount of exit strategies. So the rest of this video, I'm gonna be going over the different things that you need in order to implement the FlipSystem method. What do I look for? Because it's the method that I implement on a daily and monthly basis. What do I look for in a deal that would match that buy box of the FlipSystem method, where we buy the house, rehab it, rent it out, and then we have multiple exit strategies, all right? First, we are gonna get into the physical criteria of the property. So what criteria does the property need to fit in order to be a good first deal? So we want to hit, first of all, the 1% rent to value rule. Rent to value ratio is the value of the property compared to the rent. We want to be at a 1% or 1.0 rent to value ratio, which means a $100,000 house has to rent out for $1,000 a month. $1 million house has to rent for $10,000 per month. You'll notice as you get into real estate, there's hardly any cities where this actually meets 1.0. You're gonna be right around 0.8. But places like New York and LA and Seattle are right around like 0.2 and 0.3. So it's just a quick rule of thumb to figure out if that property is gonna cash flow or not. Number 2, low property taxes. I don't want to invest in places that have high property taxes. Why? It affects my cash flow. So instead of making $400 a month, I'm now making $100 a month because there's such high property taxes, or they're always increasing. That's not going to be a good place for me to invest in the long run. Next, low crime. I want the property to be physically located in an area that doesn't have a high crime rate. Why? More turnover, more break-ins, more maintenance and repairs, lower quality of tenants, higher turnover with the tenants. There's so many reasons why I don't want to invest in a high crime neighborhood. A lot of real estate investors talk about property class, right? The A, B, C, D, E, F, or maybe they skip the E. A, B, C, D, F, right? I like to invest in B and C class neighborhoods. This is going to be the mixture between white collar and blue collar. It's not going to be the A class, super luxury white collar, and it's not going to be the F class, which is going to be rough neighborhoods. I want to be right in the middle. So the workforce housing is what we like to call it. Bedrooms and bathrooms, I like to be at least a 3-bedroom, 1-bath. That's what I would recommend for you for your first deal. Once you start scaling up, you can get into 3 2s, 4 1s, 2 1s, but I really like to be a 3-bedroom, 1-bath. In the Midwest, 70% of the inventory-ish is 3-bedroom, 1-bath houses. Very common. Square footage wise, I like to be anything from 750 square feet all the way to like 13 or 1400 square feet. That's kind of where I like to be. I don't want to be too small because it's going to really affect rent and resale value. And I don't want to be too big because the unit turns. For example, when a tenant leaves and it's like a 2,000 square foot house, it's going to be very expensive to repaint, clean the entire property, right? So I like to be in that 1,750 square feet to 1,300 square feet. It's just going to be way more cost effective. Last but not least, I like to have an unfinished basement, but I want it to be clean. I don't want to be dirty with cobwebs everywhere. A nice clean basement, if you invest in a place that does have basements, I want to be a nice clean basement in the property. So that's great, Antoine. Thank you so much for all the information. But how can I go and find properties like this? You can set up filters on Zillow and get email alerts. So you're just going to set your criteria. 3-bedroom, 1-bath, this square footage, these kinds of neighborhoods, map them out, plug in your email, and it's going to email you on a daily basis deals that match that criteria. You quickly analyze them and make an offer. Cool. Moving on, financial criteria. So what kind of financial criteria do I look for when investing and buying these properties? So there's 2 kinds of financial criteria that I look for. Number 1, ARV ROI. And the rental income ROI. So those are the 2 things. I'm going to break those down for you. And why are these important? Because the deal has to be worth your time. If we're only going to make a 5% return on my money, let's go put that in a high interest savings account, right? We have to make sure that the deal makes sense for us. And if we want to sell it as a turnkey investment, that the buyer on the back end is going to make a return, or if we want to burr the property and hold it, that the return is going to make sense for us in the long run, right? So first, let me explain what ROI means. If you don't know, ROI means return on investment. It measures how much money you can make from the property compared to what you invested, and ROI is a percentage. The higher the percentage, the more money that you are making, right? A 50% return on your money means you invested $2 and you made $1 back. All right, now what is ARV ROI? So ARV stands for after repair value. Essentially, you want to calculate the return on your investment, the ROI, after renovating the house and increasing the ARV. The ideal ROI or return on investment for these turnkey fix and flip deals that you do is around 50 to 80% ARV ROI. So how do you calculate this? First, you want to take the profit, the net profit. So if we're buying a house, renovating it, renting it out, we're getting a loan on the property. Let's say we're making a $10,000 profit at the end of the day on that fix and flip property because it's an ARV ROI. We're going to have a $10,000 margin. Cool. The amount of cash we need to buy that property is $20,000. $20,000 investment, $10,000 in profit. You take $10,000 divided by $20,000 to get your ROI, which would be a 50% return on investment, which is right in the range. So that's the kind of range you want to be in, and you can just play around with those numbers. All right, next is the rental income ROI. This is how high of a return the rental income is making you compared to the investment that you made. So this is really useful when you go to sell the property. We want to make sure that when we do sell the property, the buyer on the back end is making enough cash flow and making a good return on their investment. Why would we want that? Because if we buy a house, renovate it, rent it out, we want to go sell it to another investor. If they're making a 4% cash on cash return or 4% rental income ROI, probably going to be hard to sell that. But if it's making a 14%, it's going to be super easy and we can sell that house in a weekend, right? So that's why it's important before you buy these properties to calculate the rental income ROI for the end buyer. So the ideal ROI that I've seen in the market today to sell a rental property to another investor after you buy it, rehab it, rent it out, and sell it is around 8 to 15%. 8 to 15% rental income ROI, okay? And this number is gonna be based on your ARV and the market rent. So if you buy a house for 80,000 bucks, it's rented out for $800, but you're gonna renovate that property and it's going to be worth $150K and it's going to rent out for $1,500. We're going to use $150K and $1,500. Okay, so it's going to be all the future. We're going to bundle the house together and sell it to another investor. What is their cash on cash return or the rental income ROI going to be? All right, so how do you calculate this? First, you're going to look at the cash flow per month. Okay, so we're gonna go sell this property for 150K. The buyer's gonna come get a loan, 80% loan to value. They're gonna put some money down. At the end of the day, with their 7.5% interest rate, you'll have to make all these assumptions. They're gonna make $200 per month in net cash flow. Okay, to buy this property, to keep the math easy, let's say they have to come out of pocket with 24,000 bucks. All you gotta do is take $200 per month times 12 months, which is $2,400 a year in net cash flow. Divide that by how much they invested, which is $24,000, to get the rental income ROI to hit in that range of 8 to 15%. Okay, so $2,400 per year, $2,400 per year in net cash flow, $24,000 investment. That would be a 10% rental income ROI, which is right in the range, and that means that house will be relatively easy to sell if you do marketing correctly. Now you may be asking yourself, why do we make a 50% return on investment and our end buyers only making a 10% return on investment? Well, it's because you took the risk. You took the risk to buy the house, renovate it, rent it out, sell it, bundle it all together, right? The end buyer who's buying the product is just getting a loan. The house is clean, safe, livable, property manager in place, fully renovated, tenants paying rent on time. So for you taking all that risk, you can make 5 times the amount of return versus buying turnkey rentals, which you make a fifth of the return. 50% ROI versus a 10% ROI. So people have different strategies overall. Some people just want to buy the rentals and they just want to go to bed at night. Other people, like me and you, like to be active and be more active in the deals. We want to go search for the deals, get the financing, renovate them, be a part of the entire process. Now, the great thing about the FlipSystem method is that you and I can do both of these strategies, right? We can take the heavy risk, and then once the deal is done, we can refinance it and boom, that deal's in our portfolio. Or, hey, we got an amazing tenant in this place and the rent is way higher than we expected, or we overspent on renovations. We need to get our money back. Great, let's sell this property. So by doing and implementing the FlipSystem method, as you go through the deal, you can really see, all right, I want to hold this one, or I want to sell this property. All right, now that we finished the criteria, I'm going to go over the 2 ways to find your first investment property. Number 1 is on your own, and number 2 is with FlipSystem. So first, we're going to cover how to do it on your own. Then I will show you my software and my team to help speed up the entire deal finding process. All right, so there's a million different ways to find deals and a million different websites you can use to go and find your first real estate deal. You can use Redfin, Zillow, LoopNet, wholesalers, realtors, bandit signs, property managers, direct mail marketing, cold calling, Craigslist, right? There's so many different ways to go about it. I would recommend starting with Zillow and Redfin. These are going to be deals that are on the market. They're posted by realtors. It's going to be everything above board. I wouldn't go into the wholesalers, bandit signs, cold calling, all that kind of stuff for your first couple of deals. Just do something super clean and super easy and look in the right market where there are deals on the MLS. I get so many comments, people saying, well, there's no deals on the MLS where I want to invest. Change where you want to invest. You can invest virtually. You don't have to invest in your backyard. Let's say you go on Zillow and Redfin and Trulia, all these different websites, and you found some houses. Now we need to go over analyzing those deals. So I'm going to go to my computer and share my screen with you all about how I analyze deals today. And this software that I'm using, you can use a link down below in the description box to get access to this calculator completely free, okay? So I'm going to change to my computer and show you guys how I currently analyze deals today. So essentially how this FlipSystem marketplace works is that we have direct MLS access, okay? So as a deal is posted on Zillow and Redfin and Trulia, it comes right into the FlipSystem marketplace. I can go ahead and add this deal to my property queue. I can open it up in properties, I can open up the address, and now the numbers are all there for me. So I can see the after repair value. I can see the purchase price recommended. I can look at the repair costs, utility expenses, sales costs, what my profit will be, the taxes, project duration. I'm gonna use a hard money loan, so I'm gonna fill in those 2 fields, right? So all of these deals that come in via the FlipSystem marketplace are already pre-analyzed by our team of experts. So deal comes in, it doesn't go right to Zillow and Redfin, it comes right to our portal. Our team analyzes it, clicks publish. You get access to a ton of deals that are already pre-analyzed to really, really speed up the process. Because obviously if you have to analyze 100 deals to make a couple offers, it's gonna take a ton of time, especially if you have a full-time job. So what this is gonna do for me, remember we went over rental income ROI and then ARV ROI. So this is gonna show me the ARV ROI, you can see it's 70%. So to buy this deal, for example, this one right here, which is for sale, $37,500 in St. Louis. I'm gonna get a hard money loan. I'm gonna need $16,000 to do the deal. I'm gonna make 11,000 bucks in profit, a 70% return on investment, ARV ROI, in 4 months. Pretty cool. Now we're gonna buy the house, renovate it, rent it out, and then sell it. So this is the turnkey flip analysis to sell this house to another buyer. They're gonna come in. Remember I said market rent. They're gonna get a loan, 7.5% interest, and they are going to make a 10% cap rate or a 15% cash on cash return. Remember, the range was 8 to 15%. So this deal, just from the looks of it, is amazing. This is something that I should go and buy, make an offer for $32,500, which is a little bit below asking. I can go make this offer, get it under contract, and then go through the entire process, sell it to an end buyer, and they'll make a 15% return on their money. So again, if you want access to this tool, to this analyzer, click the link down below in the description to get free access to it. So there are some other tools out there. Obviously within the FlipSystem portal, everything is inside of there. But if you were to analyze these deals yourself, for example, looking at the annual taxes for this house, which is $1,459. Typically, you would have to go to the city and county website, depending on where you're investing, pull those numbers in, and then put them into your spreadsheet that you may be using Excel or the FlipSystem portal to do that. The second one that I want to point out is the market rent. We use a tool called Rent-A-Meter. Rent-A-Meter is a great tool, I love it. I would highly recommend using Rent-A-Meter to come up with market rent. The great thing about the FlipSystem portal is that it already has Rent-A-Meter numbers integrated inside of it. So these market rent figures are coming right from Rent-A-Meter already, and that's all done for you. So those are two tools that I would use. One, Rent-A-Meter. Second, the county or city websites to come up with the actual property taxes. Don't use the property taxes that are coming up on Zillow and Redfin and Trulia. Typically, those are not gonna be accurate. The other kind of tool that I use is gonna be like a crime map. However, if you have a great team on the ground, that's gonna be better than any crime map ever. So there are a ton of tools out there to look up crime maps. All of them have relatively the same amount of data. What I like to do is build a great team on the ground, realtor, property manager, contractor, insurance, title company. And from there, I ask them what they think about the neighborhood, what they think about the property. That's gonna be better than any crime map online, and it's gonna be way more customized. Because if a property manager manages 100 houses in a zip code, and they have great success collecting rent, tenants never turn, they always pay for rent increases, that's way better than any data from any crime map online. Cool, so let's say we analyze a deal. There's 3 checkpoints after we analyze that deal to get that deal under contract. Number 1 is a manual analysis that I just showed you in the FlipSystem portal. Going through that manual analysis, analyzing the property. Does it make sense for us? Does it make sense for the end buyer? Does it check all of those boxes? After that, we're gonna take these numbers and send them to our realtor on the ground. And we want them to confirm the numbers that we have in our mind, right? I'm gonna buy it for this, renovate it for this, rent it out for this, sell it for this. Do you agree with those numbers? And we're gonna get the realtor's feedback. Once we collect the realtor's feedback, we're gonna take it to another source, property manager. We're gonna ask them what they think about the rent, the rehab, the area. Same questions that we just asked the realtor. Why would we do this? Because now we have 3 checkpoints. I ran the number, realtor ran the number, property manager ran the number. So now the numbers are gonna be really, really damn good. The question is, how fast can you do these things? And can you do this faster than the rest of the competition? That's gonna be the key differentiator between you getting deals under contract or taking a little bit of time. The great thing about FlipSystem, if you use FlipSystem, use the marketplace, use our property tracking system, is you get a couple different checkpoints as well. So not only do you check it, your realtor on the ground checks it, your property manager checks it. By the way, we introduce you to a local realtor and property manager on the ground. But we also have a full-time acquisition team that's analyzing deals day in and day out. And we have deal reviews. So essentially, if you change some numbers or you get some feedback from realtor, property manager, we will actually do another deal review for your deal to make sure all looks good. Next thing is we have a customer success team. They will review your rehab bids, inspection reports, and anything you get back from your realtor and property manager as you're going through the process of being under contract. So with FlipSystem, we have even more steps to the process, which is the acquisition team with the deal reviews and the customer success team with the rehab bid and inspection report reviews. We want to make sure you're getting into a deal that is going to be profitable so you have a good experience investing in real estate. In this video, we're going to talk about how to scale your real estate business. We're going to talk about using your team, renting and selling, the different exit strategies. We're going to go over raising money and creative finance, And then we're gonna talk about how I was able to scale my fix and flip business to over 50 deals in one single month. So let's get into it. We're gonna talk about how to scale your real estate business. It all starts off with exit strategies. And I think this is one of the big pain points when people get into real estate is they don't have enough exit strategies for their deals. And then they have a big bottleneck of deals that they're trying to sell or trying to exit. And it's because they don't have enough exit strategies. There was a couple of things that I did to sell my pieces of real estate, my single family houses, duplexes, apartment buildings that helped me scale way faster. So when you go to sell these houses, most people sell these homes with a realtor, which creates another bottleneck that's not in their control. But if you actually own a house, you can sell the house yourself and you do not need a realtor. This is called a for sale by owner. It's completely legal. If you own a property, you can sell that property to another buyer, give them the contract, do everything. You don't need a real estate agent involved and you save 6%. You don't need a real estate license if you are selling a house that you own. So that's a little hack in the system is where you get to save 6% and add 6% to your margin on every single deal that you do. What does that mean? It means on every single house that I offer on, I can offer 6% higher than all of my competition. So how would you go about doing this? There's a couple of steps that you need to take in order to sell the house yourself and save that 6%. Number one, you want to create a buyer's list. What I recommend doing is going on my Gmail, Yahoo, for my whole family, myself, my brother, my kids. I go into all of our Gmail accounts, email accounts, I download all the emails, I put all those emails into a MailChimp or something like that. Then I email everybody that I know, everybody that I've ever talked to in my entire life, and I say, hey, I bought this house, I'm looking to sell it. Are you interested in buying a rental property? Because I'm selling rental properties to them that already have tenants in place that are already cash flowing. The other thing that I do is start leveraging social media. So start posting content. You can even think about running ads for the houses that you're trying to sell. But you just have to get creative in the sales process. Because the quicker that we can sell these assets, the shorter our sales cycle, the more cash that comes back to us, which means we can use that cash to keep scaling up, scaling up, scaling up. The great thing about this is that people already know, like, and trust you. You're talking to people that know you or know a family member of yours or know your brother or know your kids. So you have some sort of relationship with these people already. It's gonna make it way easier to sell your turnkey rental properties to them, which again is my recommendation. Because if I wanna go list the house on the market and pay 6% to a realtor to try to sell it to a family that I don't know, they don't know me, they don't trust me, versus renting out the house, and now I have an asset that I can sell to anybody in America instead of selling the asset to somebody that lives in a 5-mile radius with a realtor that I don't know, pay them 6%. The whole business model of retail fix and flip doesn't make sense to me. I would prefer to buy the house, renovate it, rent it out, and then sell it as a turnkey rental to an investor anywhere in America, and I get to save the 6%. All right, so that's bottleneck number one, is selling the property, taking more control and ownership over selling the property. The shorter our sales cycle, if we bring our sales cycle from 6 months to 3 months, it's gonna be a way faster cash velocity, which means we can scale way more. We can actually scale double if we sell the house in 3 months versus 6 months. Okay, the second most important thing is renting out the property. A lot of people get into the weeds and get very analytical and want to control a lot of the process when it comes to renting out the property. I don't want you to do this at all. I want you to leverage and trust the property manager, most importantly, and the realtor when it comes to renting out the property. A lot of people want to dive into the weeds here and try to do everything to get an extra $25 in rent or try to get the best tenant ever, or they'll wait months and months to try to find this unicorn tenant. That does not exist. What I recommend doing is running comps or having the property manager give me a rental recommendation, and then I want to list for that price or maybe a little bit below that price. If I do want to list that property for rent and get a tenant in there in the next couple of weeks, I want to come a little bit below market rent to just get a ton of applications. With those tons of applications, I can then choose the top tenant for me. The other super important thing with all of my houses that I've ever done is getting professional photos. A lot of these places, especially in the Midwest where I have invested, a lot of property managers, realtors, investors don't take these properties seriously. They don't take professional photos. They want to cut corners. They don't want to spend $180 on a professional set of photos. But let me tell you, these professional photos will really help your property rent out way faster than if you just took a bunch of photos on your iPhone or if you took it on an Android camera where the photos look absolutely horrible. So if you have professional photos on the property versus photos that look like they were taken on a potato, the photos from the iPhone are gonna perform way better and you're gonna be able to rent the property out way faster. So just to reiterate, I want you to stay out of the weeds. A lot of people, whether they're investing locally or investing out of state, just don't leverage their team. They don't trust other people. I recommend you trust everybody 100% until they screw you over or until something doesn't work, and then you can change and you can pivot from there. But if you don't trust these people from the get-go, you're gonna end up doing everything yourself. And that's not a way to scale a business. If you're fixing toilets and looking up tenants' background checks and checking credit scores and doing this thing and that thing, you just have 5,000 tasks now instead of trusting a professional that you have hired. Another thing I would recommend is investing in software. There's lots of tools and softwares that can help automate your workflow. So look at your day-to-day, say, what am I doing? I've done this 17 times today, or my property manager's done this 17 times, or me and my realtor have had this similar conversation 47 times. Cool, what can I put together, whether it's a software or a doc or an SOP, like a standard operating procedure? What is something that is very duplicative, where I can go and hire a virtual assistant or hire somebody locally or hire my brother or family member to help me grow this real estate business, and they can just do this same SOP, the same thing 15 times a day, which will get me more leads or more tenants or be able to sell my houses faster. All right, next we're gonna get into how to do more deals. So the first way that you can do more deals, like I had mentioned previously, is recycling your cash, and recycling your cash faster and faster and faster than the rest of your competition. How do you do that? By taking more control and being better than everybody else. So like I mentioned, a shorter deal cycle. If we can have our deal cycle be 3 months versus 6 months, we get that cash back. We can then use that cash to get into the next deal. That'll literally 2x your output on the amount of deals that you can do in a single year. So if you're doing 5 deals per year and you want to do 10 deals per year, just how can I make my deal shorter? How can I make my deal work faster and make the same, if not more money? All right, be better than everybody else. What do I mean by that? I mean looking at your competition. So if people are flipping houses in your local neighborhood, are they a realtor themselves? Are they the contractor themselves? What part are they doing? How are they finding these deals? Where are they getting these deals from? And see how you can be better than other people, right? For me, it was a lot of people were doing retail fix and flips or using other websites or using realtors to sell their houses. And I was like, if I can just control the sales aspect of selling these houses and selling these assets, I'm gonna save 6%. I can do it way faster than another realtor could, which is where it comes from, be better. If I can sell the house in 2 weeks and a realtor can sell the house in 2 months and I save 6%, that's a double whammy and it's gonna be great for my business. So you wanna look at what aspects you can actually be better than somebody else that you would hire in this business. Now, once you do sell these assets or refinance these assets, whether you sell it or burr it, I want you to get into the next deal ASAP. So what I mean by that is when I have a house, which goes back to like being efficient with your time and being better than other people. Once you have a buyer lined up or a refinance lined up and you know that that deal is gonna sell or refinance in the next 30 or 45 days, I want you to start looking for the next deal. How can we be way more efficient with our time? If I know I'm gonna sell a house in 30 days, right? And there's like a 70-30 chance that the house actually sells, I wanna start looking for new deals today, right? And I already know how much money I'm probably gonna get back on that deal. I can start looking for houses today in projection, put those houses under contract, get the rehab bid, inspection report, all that kind of stuff, so that I have that house sell. Hopefully, a week or 2 later, I already have a house lined up that is closing. And I take the money from deal 1 and move it to deal 2, right? So you have to have multiple different things working all at the same time and really plan out all of these deals that are happening when you're buying them, when you're selling them, to really make your time way more efficient, and that's how you can really double your output. Now, the other way that you're gonna be able to scale your real estate business is by not using hard money anymore and going and trying to raise private money or joint venture funds. All right, so once you have completed a couple of deals, the way that you can really scale your business is by taking those couple of deals and making what I call case studies. Hey, this is what I anticipated to buy it for, rehab it for, sell it for, profit. This is what actually happened. What I bought it for, rehabbed it for, sold it for, this is what I actually made. And looking at the difference between the two, hopefully you did better than what you projected. You can take those case studies, take it to friends and family members, people you know, take that big email list that we already talked about and send the deal to them. Hey, this is what I've been up to. Are you looking to invest with me? Are you looking to partner up with me? Do you want to flip houses together? Everybody wants to flip houses, especially if you are flipping houses in a place where they can invest 30 grand and partner up with you and flip a house. People love that. Another place that you can go to try to raise private money is going to meetups. So go to local meetups. In LA, I would go to hundreds of these meetups every single year and raise private money from these people. I would go meet people at the meetup that were begging to invest in real estate. And I would be like, oh yeah, I flip a couple houses a month in the Midwest. And I'm always looking for people to partner up with that I think would be a good fit. I would then schedule one-on-one coffee meetings or phone meetings, Zoom meetings with them, share them a couple case studies, and then they were like, please let me know about the next deal. Next deal came around a couple weeks later, I would send it to them, and then we would use their funds or partner up together and do some deals together just like that by going to these meetups, building relationships with people that I had never met before just by having these case studies. So doing a couple deals is going to be super important. And there's really two ways to raise money from these people. It's either joint venture or private money. So I'll explain the difference between the two. When you go and raise money from somebody and it's going to be a joint venture, it's where they invest in your deal and they get a percentage of the profits. So they fund, for example, 100% of the deal and they get 50% of the profits, which is typically what we would do. Or if somebody wanted to lend us money, they would lend us 100% of the funds for the deal and they would make a 12% annualized interest rate. So for example, they would lend us $100,000, we would pay them 1% per month, 12% annualized. So they make a $100,000 investment and make $1,000 per month. Those are really the two main ways and really the price ranges in which you should be raising money from other people. Now, if that sounds like too much work, because it is a lot of work, you can also build a relationship with your hard money lender and continue using the same lender that you've already used for the first couple of deals. As you do more and more deals with these lenders, the rates are going to go down. The points are going to go down. It's going to get cheaper and cheaper and cheaper to raise money from hard money lenders as you have more deals under your belt. So it ends up being around the same cost to raise from private money versus raising from hard money. The great thing about raising money from private money lenders is the speed of it, right? Everything, time is money and efficiency is money. If it takes a hard money lender 30 or 45 days to close, where it takes a private money lender, me and Billy shaking hands and him wiring money in 24 hours versus 30 to 45 days. How many more deals could I buy if I had money in 24 hours versus 30 to 45 days? Way more. All right, now I want to get into how I went from flipping no houses to a couple years later flipping 50 houses in a single month, and how I really scaled up my real estate business. So essentially, big picture, what I like to sit down and look at is a couple of things and look at where my biggest bottleneck is, right? So you have deals, capital, sales, time, and team. You have those 5 things, and one of those things is gonna be your bottleneck at any given time. And essentially, in the house flipping business, you're playing whack-a-mole between those 5 every single day. And it also ebbs and flows. You either have way too much money and not enough deals, way too much deals and not enough money. You have way too many buyers and not enough houses. You have way too many houses and not enough buyers. Everything is whack-a-mole, and it's those 5 things that repeat over and over and over again, and they cycle in and out. A lot of people, when they get into the house flipping business, say, I can't wait till my whole business is just streamlined and I get to just go on a yacht. It doesn't get there. I've tried to get there. It doesn't get there at all, ever. And I'll even go over how I try to solve some of these bottlenecks, but it's always going to be ebbing and flowing because we are in a market. It's not like I sell socks online, right? Where I have like people pre-order a product, I produce it, and I sell it. We are dealing with a market. The problem with a real estate market is that we are not in control of the supply. I cannot go, well, I technically could go build more houses, but then I would have to find the land, and then I would have to go and buy the land on a marketplace, right? So the problem always is that I cannot control, 50 people listed their house this month, and the next month, 10 people listed their house, right? I am not in control of the market or the supply of the real estate market, and it makes it way more of a whack-a-mole game that you have to play in the house flipping business. So what I want you to do as you scale up and as you continuously scale up your real estate business, your house flipping business, is I want you to find the number one bottleneck. Out of all of these things, out of these 5 things, what is the number one bottleneck that is stopping me from doing more deals? So for example, if I am going through my business and I'm like, man, I have enough capital, I have sales down, I have enough time and bandwidth personally, and my team, internal, external, also has bandwidth, we just don't have enough deals to put through the pipeline. What can we do to find more deals? And this was something that we dealt with over the last 10 years as well. What we did is we automated the MLS going into your software. So how are you analyzing deals currently? Are you going on Zillow and Redfin and Trulia? Cool. Who is doing that? Do you have a deal analyzer doing that? Are you doing that personally? Right? If you're doing that personally, then you probably have a time constraint as well. It's not a deal constraint, it's a time constraint on you going and finding those deals, right? So how can we have software or tools, or what can I buy? Can I buy a license for Detroit MLS that then feeds into some software that I make? Or can I go and buy a software that automatically analyzes deals like the FlipSystem software does, automatically analyzes deals for me so I don't have to spend any time analyzing deals, and deals are fed to me on a daily basis. So that's one of the constraints and one of the solutions that we had implemented. Another constraint that we fixed was capital constraints. So typically people find a ton of deals, especially as you do more and more house flips, you're gonna find a ton of deals and deals are gonna start coming to you. Your team is gonna probably have some bandwidth or maybe a little bit of bandwidth constraints on the construction aspect, and you probably have sales down, let's say. The problem is going to be you have way too many deals and you don't have enough money to do those deals. And then your team may be a little bit constrained, but you can always add new people and new resources to help that constraint. So what did we do for capital? We realized when we went from hard money to private money, raising private money, it was taking a lot of time to build the relationships with these private money and joint venture lenders. So we got to thinking, man, if we can just find a private money lender that had 50 million bucks, I would have to talk to one person and not talk to 500 or 50 people to raise $50 million, right? So that's exactly what we did. We started calling around family offices and saying, hey, we're house flippers. We flipped hundreds of houses. Here's all the houses that we flipped. Here's the average profits. We're looking for a line of credit. And we went to all these family offices and pitched a line of credit. And guess what? We got one. We got a $25 million line of credit. We would fill out a spreadsheet for this family office, put some information in about the deal. They would wire us the money within 24 hours. We were auto approved all the way up to $25 million, and we would have anything from $1 million to $10 million pulled out of this line of credit at any given time. Essentially, when we would sell the asset, we would give the money back to them. We would get to keep the profits. So that is one of the constraints that we had, which was capital. How did we fix it? Went and raised a shitload of money from one person. What did that do? It solved all my capital constraints. I never had to raise money ever again from that one move and one decision. The other thing it did was save me my time. I was out there building relationships, networking, calling with people that wanted to invest in real estate, just like I did from the very, very beginning, to go and raise money from private money investors and private money lenders. I now needed to spend zero time and I had no capital constraints. It was a double whammy. 2 of the 5 things were completely done with just by building that one relationship with the family office. If this sounds like a lot of work, you're absolutely right. It would take me typically 2 years to build a brand new team on the ground. That includes flying there, traveling, cold calling, testing, losing money with this team, with this realtor, with this property manager, losing so much money along the way. And it took me so much time as well. It took me 8 hours a day for 2 years. I was working on this full time, probably not even 8 hours, probably 12 hours a day, full time for 2 years to actually build a great team on the ground and start my real estate investing business. But in the end, it all worked out because I was able to build a multi-million-dollar house flipping business from California in the Midwest. And I did it alone, but you don't have to. I made a system to help you invest in real estate. I will give you all the contacts to all the people that I know on the ground so you can skip the cold calling, the traveling, the testing, all that kind of stuff. I can connect you with a local team on the ground. And that local team on the ground is going to be in the same exact cities and states that I have been investing in for the last 10 years. Then on top of that, I will actually help you pinpoint the right deals that will be great purchases for you to buy, renovate, rent, and sell, or refinance. And my goal is to coach you every step of the way for the next couple of years so that you can learn how to invest in real estate profitably and go and do it on your own. You can 100% invest in real estate alone, but my recommendation is to skip the trial and error and work with a team on the ground and people that have already been there and done that, right? You get to skip all the battle scars and just go right to investing in real estate. It's always gonna be faster and easier, and you're gonna lose way less money if you work with a team that knows what they're doing. So if that sounds interesting to you, click the link down below, book a free consultation with my team and I. We'd love to show you more about FlipSystem and how we can help. See ya.